Hi, my name's Jonny Christensen. I'm the co-founder, CEO of Red Sign Team, which is a real estate sales team here. I would like to go through an exercise that I've done 100 times when I'm talking to potential or even current investors on why they should be purchasing real estate investments. And I'm going to walk through on the board a real life scenario of what the potential return of investment is when you go buy a typical rental property. So there's four main benefits that I talk about. The first one is appreciation. Appreciation. When you buy a rental property, the entire value of the rental property goes up constantly, right? So say you go, let's use a realistic median price purchase right now of $350,000. Say we go buy a condo that's a $350,000 purchase price. We're going to get a 10% loan, which means we're going to put $35,000 down. And then we're going to go get a mortgage for the other $315,000. Okay. So when you buy a rental property, there's four different benefits that you get. Number one is appreciation. Number two is cash flow. When you buy a rental property, you want the rent that you collect to offset all expenses and hopefully net some positive money. The next one's going to be tax benefits. Okay. So tax benefits. There's some really cool tax benefits that come along with owning a rental property. And then the last one is what I call debt reduction. Every month when your renter pays the mortgage payment, it actually reduces the principal balance of the mortgage that you got, okay? So for example, 10% down, $35,000 is what we're gonna invest to buy this rental property. When the market goes up, do you get appreciation on the $35,000 or do you get appreciation on the entire $350,000? You get the appreciation on the total value of your rental property. Say you invest in the stock market. On average, the last, whatever it was, 30, 40 years of the S&P 500, it's averaged about 8% appreciation a year. So if I actually invested $35,000, the market goes up 8%, my $35,000 would now be worth what? I got my trusty calculator here. Times 1.08, my $35,000 a year later would now be worth $37,800. But when you invest into real estate, the whole power of leverage, which is the cool thing about owning rental properties, you go buy a purchase price of $350,000, the market goes up 8%, that $350,000 is now worth $378,000. So the difference is $28,000 versus $2,000, right? So the power of leverage to go out and get mortgages, put only 10% down and get the full appreciation is incredible. So $350,000. Let's go through a couple scenarios real quick. Over the last 50 years of the real estate market, the average appreciation over 50 years, so even the ups and downs, the average appreciation of a home has gone up 4%. So let's even say the market in 12 months after we buy this goes up 4%. 4% appreciation, that means our $350,000 rental property is now going to be worth $364,000. So which is basically a gain of $14,000 of equity in just 1 year over the standard over 50 years of appreciation, okay? So $14,000 divided by $35,000, because that's what you put into it, is a 40% ROI of your money in 1 year. 14,000 divided by 35,000 is a 40% ROI. So even just that one category alone is incredible. What the market's done the last several years, even this year, the last 12 months, we've averaged like 27% across the state. Even the last several years has been probably more like 10%. So just even imagine 350,000 goes up 10%. That would now be 350 times by 1.1, so 385. That's $35,000 increase, which again, 35,000 divided 35,000, that'd be 100% return of your investment in 1 year. Crazy, right? So let's even take that same thing and talk about cash flow. So $350,000 purchase price, we put $35,000 down. We know you're going to get a mortgage for $315,000, right? Average principal and interest payment on that, say a 3.5% interest rate would be about $1,400. Okay, you're going to have probably about another $100 of property taxes and insurance, say an HOA fee of $180, and then maybe say it's a brand new condo, so you might have a little bit of wear and tear, but most likely you might only have $50 over the next several years per month. Okay, so add all those up, 1,400 plus 100 plus 180 plus 50, 1,730. and say we go out and collect, $1,800 of rent per month from a renter, which is pretty good for a 3-bedroom, 2-bath residence right now, we're only cash flowing $70 per month. Okay, so $70 times by 12 is $840 per year net cash flow. And again, when we talk about cash flow, we're talking about the worst time ever, which is year one, because your rents are going to consistently go up over years. Even the next 3 years is projected that rent's probably going to go up 10% a year over the next 3 years. So again, buying is a lot better than renting, but even $840, which isn't a ton of money, but even divide that by your $35,000, we're talking about 2.4% ROI on your money. Okay. Now let's talk about debt reduction. Okay. Out of your $1,400 principal and interest payment, the first year, how much of $1,400 is going to interest versus how much is going to principal? Banks like to make money too. Most likely, the vast majority of that's going to interest, right? So even say that first year, $200 of that $1,400 payment is actually going to reduce your principal balance of your mortgage, right? So 200 times by 12 is going to be $2,400. Basically a 4 savings account that your mortgage is going to be $2,400 less at the end of the year. 2,400 divided by that same $35,000, you're talking about another 6.8% ROI of your investment. Okay, but again, when you start out an amortization of a mortgage, that is the worst time it's ever going to be is year one. So year 2, 3, 4, 5, as you get deeper into the amortization schedule, more of that payment is going to go to principal reduction. So your ROI is only going to go up on the debt reduction. And then let's talk about tax real quick. There's a lot of benefits out there when it comes to tax benefits, but when you're a real estate professional and you invest a lot, you can actually depreciate. One of the gift of the IRS gods is depreciating the value of your real estate. So even though on the real set of the books, you're actually making positive money, on your tax set of the books, a lot of times it will show up that you're losing money. And a lot of times that comes from the major expense, which is depreciation, which you basically are depreciating the value of the property over 27.5 years. So on a typical depreciation schedule, say even just $350,000 divided by 27.5 years, you're going to write off another $12,727 that then goes out and directly offsets your tax liability from other income sources. So say you make a bunch of money selling, real estate or whatever it is, and then you lose money on your rental property, that shows up as a deduction to offset as you combine them onto your personal tax return. So say you're even in say a federal 25% tax bracket and whatever the state is, 5-6%, say you're even a 30% tax bracket, times that number, 12,727 times by 0.3, you're basically saving $3,000, $3,800 based on your taxes by taking a loss through depreciation. Okay, so even divide that number by $35,000, we're talking another 10.9% ROI of your cash invested. One of the other things that we've been doing a lot lately is what we call accelerated depreciation. We go hire a cost segregation company that actually comes in and looks at the depreciation schedule and accelerates the more deductions that we can take in year one. And basically what happens, instead of doing it even over 27 years, you're actually taking a good chunk of it all within year one. And a lot of the ones that we've even done, we're seeing somewhere around 15 to 25% of the purchase price accelerating into year one. So we take a massive deduction that then offsets income in that same year. So let's even see what that would look like. Say 350,000 times by 0.2%. We basically have seen numbers somewhere around $70,000 of that purchase price that we write off in year one. So say $70,000 times by a 30% tax bracket with state and federal, that's a $21,000 savings. Divide that by 35,000. Again, that's a 60% ROI. So let's just even hurry and add up the conservative path and then the more aggressive path that the market's doing a little bit better, but say 40% plus 2.4% on the cash flow plus 6.8% plus 10.9%. So even in a very realistic, conservative, buying one condo, renting it out, return of your investment, we're talking 60.1% ROI. And in just a very conservative investment property, what other investment could you go get a 60% ROI on your cash invested of $35,000? Let's even say you decided to do the cost segregation and accelerate that in year one, and the market did what it's been doing the last several years. We're talking 100% plus 2.4% plus 6.8% plus 60%. We're talking 169.2% ROI of your cash of the $35,000 invested, which is just incredible. So clearly real estate is an incredible way to build wealth. And that's why our real estate team is so focused on being your real estate wealth advisor. When you buy a rental property, the benefits, again, appreciation, cash flow, debt reduction, and tax benefits are just incredible. Call us. We'd love to walk you through some of these other scenarios. Thank you.